So, you've probably heard about Allianz. It's one of the world's absolute financial giants, and they've just posted some record-breaking profits. Not only that, they're promising a massive payout to shareholders. Now, on the surface, that looks like a slam-dunk investment. But is it really? Today, we're going to break down the investor's dilemma. Okay, let's start with the big, flashy number. 16 billion euros. That's the record operating profit Allianz managed to pull in for 2024. It's a staggering number that screams financial power. But for any smart investor, you know that profit is just the beginning of the story.
And here's what that huge profit actually means for shareholders, for people who own a piece of the company. We're talking about a planned capital return of roughly 8 billion euros in 2025. That is cash, real cash, flowing directly back to investors through dividends and share buybacks. It's a number that's pretty much impossible to ignore.
Which really brings us to the core question of the day. You've got record profits, you've got billions being returned to shareholders. So, is Allianz just a can't-miss, shareholder-focused powerhouse? Or is there a little more to this story we need to dig into?
Well, the story gets even juicier when you look at something called return on equity. This is basically the report card for how efficiently a company is using shareholder money to make more money. And just look at this trend. We go from single digits back in 2021 all the way up to a projected 18.5% in 2025. I mean, that is a dramatic and accelerating improvement in profitability. It's really impressive.
So how are they pulling this off? Where is all this profit actually coming from? To really understand Allianz's strength, you have to pop the hood and look inside its profit engine. And it's an engine built on three really strong pillars.
You know, the company's real strength comes from its diversity. I mean, look at this chart. The Property-Casualty division, that's your traditional insurance, is the clear heavyweight. It's bringing in nearly half the profits. But the life/health and the asset management arms are also massive contributors, and together they create this really stable, resilient business model.
And here's how it all fits together, in plain English. Property-Casualty, or P&C, covers immediate risks. Think car accidents, house fires. Life and health is all about the long game. Retirement savings, pensions. And here's the kicker. The premiums collected from both of those businesses get managed by their world-famous asset management arm, which oversees trillions for clients through huge names like PIMCO and Allianz Global Investors.
But, of course, a company this big doesn't exist in a vacuum. Allianz is navigating a massive shift in the global economy. And for an insurer, believe me, nothing matters more right now than the direction of interest rates.
And this is where it gets really interesting, because for Allianz, higher rates are a total double-edged sword. On one hand, it's a huge tailwind. They can reinvest their mountain of cash at much, much better yields. Fantastic. But on the other hand, higher rates absolutely hammer the value of their existing bonds. This creates what are called mark-to-market losses, paper losses that can make its balance sheet look pretty volatile. Understanding this trade-off is absolutely key.
So how do we know they can actually handle all this volatility? Well, say hello to the Solvency II ratio. Think of it as the industry's ultimate stress test. And Allianz's score of 209%? That's really, really strong. It means that even in a worst-case crisis, the company has a substantial capital buffer to meet all of its promises to policyholders.
All right, we've seen a lot of good news. The bull case looks pretty solid. But a credible analysis means you have to look at what could go wrong. We have to examine the bear case and ask, what are the red flags hiding just beneath the surface?
So let's just ask it directly. What are the biggest threats on the horizon? It's a question every single investor needs to ask before they even think about putting their capital to work.
And what's fascinating here is that we don't have to guess. This is from Allianz's own global survey of risk experts. Cyber incidents are the #1 fear. That's what keeps them up at night. And that's followed by the usual suspects, the ever-present threat of natural catastrophes and the growing impacts of climate change.
And that #1 threat? It's not just theoretical. In July of 2025, it became painfully real. A malicious actor breached a system used by its U.S. life insurance subsidiary and managed to compromise the personal data of a majority of its 1.4 million customers. It's a stark and pretty recent reminder that even the giants are vulnerable.
And it's not just about operational risks like hackers. Credit rating agencies like Moody's have pointed to potential risks hiding inside Allianz's massive investment portfolio. This quote here highlights concerns about their exposure to higher-risk assets, and there's a real lack of transparency around specific areas, like commercial real estate, which is a sector that's under a ton of stress globally right now.
So, there you have it. You've got this powerful bull case on one side and a pretty worrying bear case on the other. How does an investor take all of this in and actually come to a final verdict? Let's start by really defining the core of the bull argument. Allianz perfectly fits the profile of what investors call a cash flow compounder. It's not about flashy, explosive growth. No, it's about being an incredibly efficient machine that just generates predictable, growing streams of cash and then showers its owners with it. And this brings us right to the heart of the debate. You've got two completely competing stories. The bulls see a resilient, best-in-class leader with a disciplined, massive plan to reward shareholders. But the bears, they see a complex giant that's exposed to all sorts of unpredictable shocks, from cyber attacks to those potential hidden risks in its investment portfolio. And so ultimately, it leaves us with this one final question. Is Allianz a resilient, shareholder-friendly cash machine that's perfectly positioned for this environment? Or is it a complex giant whose very size and scope leave it dangerously exposed to the next big, unpredictable shock? The answer to that question, well, that's the investor's dilemma.